this. Welcome back, everyone, to Ready, Set, Go Real Estate Investing Podcast. I'm your host, Mr. Brandon Elliott. I'm excited today. We're going to be diving into a tax strategy and a way to really excel and increase your cash flow in a unique, different way that I've heard about in the past over the 7-8 years that I've been investing in real estate actively, and I haven't actually utilized this tool until now. Like I'm just starting to do it. I had some buddies of mine say, "Hey, what the heck are you doing? Why are you paying so much in taxes? Why are you not writing off as much as you could?" And yeah, this really just opened up my eyes tremendously. I made a post on social media asking, who is the best of the best in this space, and what was really cool is Yonah was brought up to me like several times by several people. And as I started going down a little rabbit hole of, his content and everything that he puts out, it was a no-brainer that he is excellent in his space and a true expert. So today what we're going to be covering is cost segregation. So cost seg, a lot of people sum it up to, and it is a form of, well, I'm not going to steal the thunder. I don't want to butcher it really. But without further ado, Yonah, do you mind just, diving in, let people know that 30,000 foot view of who you are, where you're from, what you're up to, and your real estate background, and what the heck we're going to be covering today?
Yeah, absolutely. It's great to be here, Brandon. This is awesome. I love doing the live streams. But yeah, if anyone is watching out there live, make sure to put in the comments, where you're watching from. We always love to see the interactions there and questions. I'm sure you're going to have lots of questions on this subject, but yeah, I am. And it's funny what you said about the social media, because it's been an incredible ride. Social media has been a blessing because it's just enabled us to grow in so many ways, just building that personal brand and becoming known literally across the country as like the cost segregation expert, even though there are many, many, many other companies out there. Just no one was really going hard in this space when I started a few years ago. So grateful for that. I was a teacher for many years. So about 15 years, that's really my passion. And I've really brought that into what I do now, because everything I do, essentially, we're just teaching, we're educating people about this subject. And that's, I think, why it's so easy for me to, to be the cost segregation expert, even though the real experts are the accountants and the CPAs and the engineers on our team that have been doing this for decades. But when they come out to speak, they're like, very technical. I mean, I've actually heard some podcasts with other people talking about cost segregation, and
talk
if
about
they're
boring
CPAs or they're engineers, it is a little bit. It's a little bit dry. Most of the time, they use terminology, acronyms, and all kinds of things without explaining it. So, being a teacher, like that's one of the biggest pet peeves that I have is when someone is speaking to an audience and they don't know who the audience is. It could be a total beginner, and they're just going to get turned off if they don't even understand what you're talking about, using jargon and all kinds of stuff. That's one thing I try to be very mindful of, explaining every concept. So I got my background, like I said, teaching. About 7 years ago, I transitioned into going into real estate. I was looking for more than just what a teacher salary would provide, and found real estate as a great kind of industry where there's so many opportunities. A bunch of my friends were doing various things. So I started doing first with commercial mortgages, actually. And then I got my residential broker's license and was doing some, just trying to find some properties. We did some fix and flips with a partner of mine. And I really didn't like that very much. So I was still looking for something else. And this opportunity with this company, Madison Commercial Real Estate, came my way, and I just jumped on it. So that's about 5 years in the making now, over 5, almost 6 years already. With Madison, it's just been amazing. It's a great company, the largest national cost segregation company, not an accounting firm, just focus on the cost seg. So that's kind of where I got my start.
I love it. Yonah, so talk to me, why was fix and flip not your caveat? Like why did you not get gravitated towards that?
It was new to me, obviously, and I didn't really like dealing with contractors. I know it's very cliche and very common, but there's a reason for that. I mean, there's a reason why people get turned off for that type of business when you're dealing with people who are dishonest.
Sure.
And to me, that really bothered me the most. That and the fact, combined with a lot of factors, it just, it was a sign. I see everything in my life as a sign from God. It's really just, providence directing me in a certain direction. It was like, okay, this is not really working. We didn't make money from like the first flip we did. We're like, okay, we did it. And then, did another one and like, okay, we're going to make money in the second one. And the second one made some money. We're like, yeah, let's do another one. And then it sat on the market for like 9 months, literally.
Yeah.
And
the
so,
sign of 3, you were like, all right, I'm done,
it was enough. Yeah, it was enough.
Yep.
My partner went on to do a few more and then he got frustrated with it also.
Yeah.
But to me, it was not my calling.
And what market is that in?
Those were all in New Jersey.
In New Jersey. Is that where you're from right now? Like
that's no, actually, living? No, our company's based in New Jersey, but okay. I'm actually in Israel right now. So I'm originally from California, but been living in Israel of most recent and working remotely.
I love it. So I'm from New Jersey originally, but I live out in San Diego, California. So
cool.
That's haven't been to Israel yet, but would love to.
A lot of connections there. I went to SDSU. So there you go.
That's so cool. Cool, man. So talk to me about the cost seg. Like what the heck is that? If anybody this is the first time them ever hearing it, just like I was a couple months ago. And what are the benefits? What does that truly look like?
Now, what is cost segregation, right? It's a weird name, but essentially all it is depreciation.
Yeah.
Okay, depreciation is a tax deduction that you get when you buy a property. Besides for your primary residence, any type of investment, rental, or business property, the government, the IRS says you're able to literally take a tax deduction of the whole thing. Okay. Yep. So you take off a certain amount for land, which doesn't depreciate, but the rest of the building and everything that's on the building and inside does depreciate. However, you can't take it all as a lump sum deduction. What you do is most accountants know that depreciation you put on a 27.5, very arbitrary number, 27.5 year schedule for residential properties and 39-year schedule for commercial properties. But what the IRS says in kind of the fine print in a different section is that you're really supposed to depreciate components of the property on different schedules besides for that, longer 27.5 or 39 year. And so that's where cost segregation comes in, is that we segregate that cost. We break down that cost into its different components, and certain components, things that are non-structural, for example, furniture, fixtures, appliances, shelving, cabinets, flooring, all kinds of stuff like that, that is, not part of the structure of the building, actually depreciate on a 5-year schedule. So the job of a cost segregation engineer, and that's what we are, we're an engineering company essentially that, examines the property in all of its details and then breaks and shows how, you have the appliance, you're just looking in the room behind you, you have the shelving there, right? The screen, the lighting, all that stuff, the curtains, the window fixtures, all that depreciates on a 5-year schedule. We're able to take the value of those and then depreciate that faster, meaning take a tax deduction of the value of that stuff over a much faster period. So long story short, it's a cash flow mechanism, right? It's a tax tool that allows you to take more deductions upfront, which gives you more cash to work with to reinvest.
I love that. So at the end of the day, you guys come in and really get nitty gritty, like look at every little aspect, the paint, the carpet, the trim, the appliances, every little thing and detail in the house. And then you itemize it and then you break down what it's worth, what the cost is, and what the replacement value would be. And then you start deducting that, but instead of for residential, in this case, a 27.5 year deduction or commercial 39 years, then you can deduct it a heck of a lot sooner in a 5-year term, you're saying?
5-year, exactly. That's the main category that's reallocated. And then there's another category that's on a 15-year schedule, which is land improvements, things that are on top of the outside, like landscaping, pavement, concrete, fencing, signage, all that actually depreciates on a 15-year schedule. Okay. And so both of those, the 5 and 15-year, are broken out from the structural components of the property, which really depreciate on a 27.5 or 39-year schedule. And the crazy thing is that this is not intrinsic to the property. Okay. This is a tax deduction for you, the owner.
Yeah.
which means when you buy a property today in 2022, you're able to start that schedule today. That 27 and a half years starts today when you buy the property, not when the property was built, or if it's a property built in 1917, and you're like, oh, it's already been fully depreciated. No, it's a tax deduction for you, not intrinsic to the value of the property.
That's so good. And so there's no other breakdowns besides 5, 15 year and like 27 and a half for residential.
Basically not. There is a category that's on 7 years, but those are mostly for commercial properties, very, very small things that fit into that category. But yeah, essentially we're looking at 27 and a half, 5 and 15.
And then is there any reasoning behind, I know this is like more of a government probably question, but like, why did they come up with these years, the 27 and a half, the 5, the 15, how did they come up with this stuff?
I don't know the exact reasoning. They're called, and it's in what's called the cost recovery system. So they kind of give what would be deemed as the useful life of these certain types of property. So in theory, right, you need to replace the appliances or the carpeting or whatever every 5 years. In theory. Now, it doesn't mean that you are going to, and it doesn't mean that, if you don't, you're not able to take that deduction anymore. It just means that's where they kind of categorized all this stuff. And, if they wanted to do it more efficiently, they could have literally, given certain things a 3, 4, 5, 6, 7, 8, 9, 10, everything has its own, specific lifespan, but they just group things together. And so that's where it came from. So I don't know. And it is arbitrary. Like why the commercial properties, live for 39 years,
39 years,
right? For 27, right? It makes no sense.
Yeah. I love it. I'm glad that they haven't changed it though, because I figured they would change it, extend it, do some weird different things. So, so it's been like that for a very long time at this point. So talk to me, what is this not good for? It's not good for fix and flips, right? You can't do it for a fix and flip. You can do it for like really buy and holds, right? Like a property that, especially for BRRRR property. So buy, renovate, refinance, or rent, refinance, and repeat. So that's what we do in all of our properties. And that can be an excellent strategy because everything's brand new at that point. And then we can write off all of those expenses that we just put into it. Correct?
Yeah. So this can be done for any type of property. You're absolutely correct. For a rental property, okay, if it is a fix and flip and you're just selling it, that's really transactional. You never rent it out. It needs to be rented out. This is a deduction specifically for rental properties. But it can be done for anything, for single families, Airbnbs, and I'd love to kind of talk about that for a little bit. Short-term rentals have a special rule related to it that actually helps with cost segregation, depreciation more than any other type of property out there. So I'd love to get into that in a little bit. Yeah, let's do it, because we've gotten tremendous amount of traction from different, Airbnb or short-term rental groups out there that, just like, everyone should be doing this. But yeah, commercial, multifamily, office, retail, industrial, self-storage, any type of property you buy, a golf course. One thing that actually has another category that has incredible benefits are mobile home parks or mobile home communities. Because, we mentioned before, you have the structural components depreciate on a 27 and a half year. And the land improvements on a 15 year. Mobile home parks, you're essentially buying the land improvements. People think, oh, I'm just buying the land, right? I don't even own any of the homes. They're tenant-owned homes, and oftentimes, right? You own the concrete and you own the landscaping, you own the pavement and the fencing. And essentially that's all you have. The land is a portion of that, does not depreciate, but everything else, essentially, there's some infrastructure that's on the 27 and a half, like the sewage and the plumbing and stuff like that. But everything else is land improvement. So we're seeing like 50 to 80% of your purchase price can actually go into the cost segregation depreciation, faster depreciation. And why that's so significant. Whereas with like a multifamily property, it's more like 25% reallocation. Why it's so significant is because of something called bonus depreciation.
Okay. I do want to talk about bonus depreciation because there with cost seg right now, I think there's some laws in place that kind of cover, I guess by the end of this year, you can get a full 100% bonus. And then next year it'll start dropping down to 75%.
It's going to be, going to start phasing out by 20% each year. So next year it's going to be 80%, then
Gotcha.
60, 40, 20, and then no more bonus depreciation. So it's not a bonus like you would think it's a bonus, like something extra, right?
Yeah.
Which we think, oh, bonus, I got to get extra depreciation,
Yeah.
right? But you're able to take, once you've done a cost segregation study and allocated those depreciations to, faster schedules like 5 and 15 years, those categories, we can now take that in the first year as a lump sum. So think about that for a second. Maybe I'll paint a picture with some numbers. I know a lot of people, they hear about taxes and they hear about cost segregation and they're like, numbers, I don't like taxes. That's what my accountant deals with. This is really, really simple. Okay. I'll literally break it down really simple. Let's say you buy $1 million property. Okay. And you're able to start your depreciation schedule today, right? 2022. Yeah. You have to allocate a certain amount for land, which doesn't depreciate. Let's say 20%. Okay. The remaining 800,000, you're able to now take and depreciate that over a 27.5-year period, which winds up being about $28,000 a year, give or take. I've done this a few times, so just trust me. Or you can do the math yourself, right? All right, which is great anyways. I mean, you think about it. You bought a property for $1 million. Whatever money you're making from that property, let's say you're making $50,000 net operating income. Okay, that's about a 5% return. You're able to literally take right away almost $30,000 of a deduction and only be taxed on the remaining $20,000 of that income. So it means you're automatically getting this huge tax benefit. But with cost segregation, and we can, let's say 25% of that, we can take upfront in the first year. Okay. Now we're talking about $150,000 or so, right? $160,000, or we're able to take that literally in the first year as a tax write-off.
Wow.
And so you're able to not only not pay any taxes on legally. Remember, guys, everything is legal here. From the tax code.
Yeah, I'm not bringing on like anybody that's bringing something totally outside of the box. That's illegal here, guys. This is truly in the tax code, and this is how the rich are doing it.
It's amazing. So once you do that, you're literally able to take, not pay tax and then have these extra losses, these extra deductions to either carry forward or to offset your other sources of income if you're like a real estate professional. So yeah, I mean, it's huge. I mean, you said yourself, this saved you like $1 million in taxes this year. It's crazy.
Like this year, like it's just crazy to think about, and because we have Airbnb as well out here in San Diego. And so, I mean, just thinking about how much, and I think before it was like 30,000 originally that we were just deducting per property, something like ridiculously small. And we weren't breaking down all the other small factors. So this is going to be truly like life-saving for my taxes. Instead of paying Uncle Sam $500,000 or more, I'll be able to actually pocket that. And then anything that is left over, if I didn't have to pay that much in taxes, then because I have a very savvy tax person as well. So once I can always roll that over to the following year, which is amazing.
It's crazy, right? Yeah. It's unbelievable. It's really, really a big benefit here. So yeah, I mean, for the short-term rentals, it's a huge thing. The reason why, and I alluded to this before, is because normally depreciation, and a lot of people talk about this and like, oh yeah, this is the best thing ever. And it's so good. But in truth, and it'd be, just really transparent here and honest, this is not that I'm not at other times. I always, right. But this always, I actually dislike that kind of introduction to a sentence. I'm gonna be honest with you.
I'm going to be really honest right now with you.
Right. Seriously. But what depreciation usually is only able to benefit your rental income or your passive income. Okay. It is a passive deduction, and rental income is treated differently than any active income you have. So let's say you are, a W-2 employee, but you also own some rental properties. You're not able to use the depreciation to offset your W-2 income. It stays in that bucket with the Schedule E with your rental income, your other passive income. However, if you are a real estate professional, which means if you're full-time in the real estate space, you're able to use those deductions against your active income as well, or your spouse's, which is an incredible thing. It's probably the biggest benefit that there is in the tax code, except this thing called short-term rentals. There's people like to call it the short-term rental loophole. It's not really a loophole. It's really just understanding these passive activity rules, right? The passive losses where you're able to use them not only against your passive income, but also against your active income. If you self-manage short-term rentals and the average stay is less than 7 days, there's something called material participation. And there's a few different ways to qualify for that material participation, but essentially you're spending more time than anyone else.
Yeah.
You're now able to take those losses, even if you have a W-2, right? Against, or any other active job, you're able to use the cost segregation against your active income as well for short-term rentals. So it's very specific to short-term rentals. Again, average stay is less than 7 days and you have to be material participating, but this is huge. I mean, literally think about it. Otherwise, if you own a long-term rental, right? I know a ton of people that they work and they put money in, own some rentals or invest in other properties.
Sure.
All the depreciation is not really going to benefit you beyond your rental income. I myself, I'm not a real estate professional. I'm working to get there.
Yeah.
And I'm hopefully going to be buying a short-term rental in the next couple of months. But all of my investments that I'm doing, that's just helping me for my investment, the rental income, all the the limited partnerships, the passive investments I'm doing.
Yeah, so you're in passive investments, in syndications and so forth, limited partnership that you're getting more of the mailbox money, which is very intelligent as well. But you aren't able to utilize the cost seg obviously for something like that, unless the main what are they called? The people that are actually like
the partners or the sponsors, the syndicators.
Yeah, the sponsors. Yes. So they can, and that is an extremely savvy way and almost mandatory, right? Because you guys can get all of those costs back and more cash flow for every limited partner.
Yeah. So most of the partners, the sponsors on syndications, they're going to do cost segregation and pass along the depreciation to their investors according to their percentage of ownership. However, they as the sponsors will get, whatever portion they're going to get and use that against not only any rental income, but against any active income they have, which if there are syndicators, a lot of them take, acquisition fees and all kinds of other fees. That's a big amount of chunk of income. And then use the cost segregation to basically offset that, so you don't pay any taxes on that income either. But the passive investors like myself are not able to use that beyond your rental income. So any income that's coming from the investments themselves, real estate investments, that is, the depreciation can be used. So that in of itself is a huge benefit, because there are not too many other, or almost no other investment vehicles out there where you can passively invest in something and also get the tax benefits in the sense that during the life of ownership, you're essentially not going to be taxed on that income.
Yeah, that's incredible. I love that. So with the short-term rentals, long story short, it really just comes down to you can utilize that depreciation as your active income as well on your W-2 and so forth, to be able to write off all that as well, which is incredible. Bring down instead of 40, 50%, wherever you're at on your tax bracket, you can totally drop it tremendously. I love that. I'm very, very excited for this, by the way, just because obviously you already know, I'm going to save a ton of money, but the cash flow aspect now, we got to really obviously it's amazing not having to pay $1 million for my particular situation to Uncle Sam, right? Because I know how to steward the money. I know how to put it to work properly and be good with it. So now I'm going to not just save money there, but I'm going to cash flow so much stronger that I will actually be able to reinvest in more properties. The whole BRRRR strategy, the last step here is repeat. So, and that's the name of the game, right? I had I was on a Zoom call with my attorney yesterday, and he was bringing up the pros and cons of doing a cost seg. And he said, he brought up to me, obviously you're depreciating all of this a heck of a lot sooner in a shorter period of time, which is great for cash flow up front and writing off that. But what about next year when you are constantly increasing, doubling, or increasing your other businesses? How is that going to look? And as we were discussing prior before going live here, it really comes down to taxes will always be a situation, right? But it comes down to the repeat process. Once you have this new cash flow, put it to work, get more properties. And then in the future, you could do 1031 exchanges and so forth. So, I mean, there's many ways to go about this, but taxes you'll never be able to run away from. But the more planning, the more step by step and taking care of this year and the next year coming up and planning for that sets you up for success, right? Oh, you're muted right now. Sorry.
Yeah, no, that's exactly right. I coughed and I muted myself and forgot to unmute myself. It happens occasionally, but that's exactly right. You want to obviously have a discussion with your, attorney, tax attorney, or accountant. If you have a tax advisor, that's obviously the best, especially if they are, specialized in real estate, and make sure that they understand all this as well. All too often I have clients that get the conservation done or want to get it done, but their accountants have no idea what this is. I'm like, no, you can't actually do that. Yeah, you actually can. But the funny thing is like I said, this is not going to benefit everyone in the same exact way. You want to make sure it's going to benefit you. And in the long term, you're going to benefit the most if you continue investing, if you want to buy more properties. And like you said, the repeat, using the money that you're saving on taxes, using that to reinvest. Now, that's called the time value of money, which is really the main benefit of what conservation is. When you're able to use the money, reinvest. I mean, think about it. You have a choice. You can either pay taxes today or not pay taxes. Every single accountant that I've ever spoken to about this subject, who knows anything about investments and real estate, have said that the time value of money is probably the most important. Like the first thing they're always going to do for any client is try to figure out how many types of deductions they can get, how many types of deferrals, right? Either deduct or defer. Those are strategies because you don't know what's going to be in a year or 2 or 5 years from now. You want to make sure to utilize the cash you have today. And then, if you're doing it right, reinvest that.
Yeah. As you brought that up, it reminded me of a lot of, I didn't realize this, but a lot of my friends did this strategy, and my accountant and tax, filing advisor, they were kind of instructing me on this, like, hey, we have the funds to be able to pay right now for the taxes, right? And then when they come due, and then I come to find out, like, they were instructing me and kind of guiding, like, hey, a lot of people actually just work out plans and pay the fees later on by just hanging on to the money now, because, like, obviously it shows that how to put the money to work and make a stronger ROI. And at the end of the day, the fees that the IRS are charging 3-something%, it's not as much as you leveraging it and making 10-20%. So, would you rather pay today, or I highly, recommend paying later on? And once I started asking some friends, they were telling me, oh yeah, we always pay later. It's funny to see what is possible and what the rich are really doing to compound it.
So true. And there's so many different factors surrounding that. So you want to make sure, again, have someone who understands this stuff who on your team, right? Real estate is a team sport. Make sure you have someone in your corner that's going to help you.
Yeah, that's so good. So talk to me. I believe not all properties can be, even if they are rentals, can really be the best fit for the cost seg, correct? I mean, any properties that are like just 100,000 or really less than about 200,000, I believe, is what I've been educated on. It's not really worth the time or the investment behind it. Is that correct?
That's what I like to kind of, my rule of thumb is because it is a percentage of the purchase price that you're able to depreciate at a faster rate. Okay. So if it's $100,000 property and you're able to take, 20% upfront, well, that 20%, that's $20,000, let's say, still, that's just going to reduce your tax liability. That's not $20,000 that you're getting as a refund or as a check, What it is, it's reducing your tax liability. So depending on your tax rate, that may translate to just a few $1,000s of actual net benefit. Yeah. Okay. So if it's going to cost a few $1,000s to get this done, it's just going to wipe itself out. And so that's why I always say, if it's over $200,000 purchase, definitely worth looking into. we always run a free feasibility analysis, a free estimate for anyone to see for themselves what the difference would be. Is it worth it? Is it not worth it? And so that's a really good way to, just understand better if it is. But any property really can be done.
That's good. So, so I know you just started explaining kind of what it looks like to work with you guys, but kind of give the breakdown and the step-by-step. If somebody's interested in this, they understand it now after listening to this podcast, what would it look like? I know you guys give that free, example. They just need to submit their info, and then you guys can show them the pros and cons about, how much they could potentially be saving.
Exactly. And the first thing, I always love to understand, what the person's situation is, right? Are you an investor? Are you someone that is planning on buying more property? I spoke to a woman yesterday who was in tech making, mid-high six figures, and she bought an Airbnb, and she's like, I'm not planning on buying any more. Like, this one is a headache enough, this you're like, is this still going to be good for me? And I'm like, no, it's probably, probably not. You can get the benefit now, but if you take 20 or 25% of your deductions in the first year, that means every subsequent year, you're just going to have, relatively less deduction. So that's the first thing I always love to understand where the person's coming from. And then our process is really, really simple, really straightforward. We charge, a flat fee, not based on your tax savings or a percentage of that. It's just a flat fee for every type of property, from usually $3,000 to $6,000, like the range of most types of properties out there, unless like a huge skyscraper or something, then it's a little more. And we'll send an engineer to the property. So this is really the most important part of is the site visit, making sure that our engineers capture everything that's inside and outside the property through video and pictures. We've actually transitioned from, during COVID, when that happened, we couldn't send our engineers physically to properties. We ended up transitioning to doing a lot of those site visits remotely. So currently we're doing a lot, especially smaller residential properties. It's really easy to just get on a video call with the engineer, they're able to walk through property, see everything, point out this, that, and the other thing. And that's pretty much it. Once we have that documentation, our engineers take it back. It's about a 6-week process or so to gather some documents like closing statement, appraisal, and then make it all into this detailed report, which is called your cost segregation study. In that, there's a depreciation schedule, basically a Excel sheet that your accountant uses to just plug in those numbers. Excuse me, what is your tax deduction year after year?
Yeah,
that's pretty much it.
Yeah. And then how long does the process typically take?
So beginning to end, about 6 to 8 weeks.
Yeah. Okay. And then, so you're saying roughly, depends on the size of your property. Don't expect if you have a 100-unit building here that it's going to be the same price, but the investment behind this is anywhere from like $3,000 to $6,000. And
exactly.
And there can be tremendous savings, just like mine. I think we are doing, it is like 4 or maybe 6 properties of mine. And it is, because they're all well over $1 million, and they are, I'm going to be saving roughly about $1 million, which is crazy.
Yeah, it's crazy. It's awesome. That's awesome.
So very excited. But cool, man. Well, I appreciate your time so much today. Any like last words for the audience to be able, like, if they're on the fence or really just don't, like, if they want to get more information about this, what does that look like? And then feel free to plug any socials or how people can get a hold of you.
Yeah, I mean, you can find me anywhere. I'm on all the socials. Most active is LinkedIn. Cool. You can find me there, but on all the places you can find me. Or you can go to YonahWeiss.com. But yeah, if you are on the fence or you're looking into this, you can reach out. We can. Madison Specs, that's our company. We're the largest national company that does this. All types of properties, again, not just for single families. And you can get a free estimate and see what that looks like. And really just make the decision for yourself. Have an educated conversation, hopefully, with your accountant, and make sure that they understand this and understand the benefits, as well as the the downsides as well. Like you said, if you're buying a property and selling it within the first year or two, and you're going to be hit with that recapture tax that we mentioned, it's probably not the best idea, because that time value money period is much shorter. It still may be a good idea, especially if you continue buying more and more, and you can use that cash flow.
Cool. I love it. Yonah, well, you're the man. I appreciate all your knowledge. I appreciate you being in this space to be, and your teacher background to help break it down so simple for everybody. It's been a wealth of knowledge and great time spending with you. So I appreciate you greatly. Guys, if you haven't, like, reach out to Yonah. He is he's got amazing content, and just get your quote, like, see what it looks like to work with him and see how much it could save you. And if it's a good fit, then go that route. If not, talk to your board of advisors, right? Like, talk to your tax filing, your attorney and so forth, just to make sure that this makes sense to you and your overall long-term plan. But with that being said, guys, make sure you hit that subscribe button to Ready, Set, Go Real Estate Investing Podcast. You'll get the newest notification every single Monday. And leave that 5-star review. Greatly appreciate all the love and feedback. Feel free to share this out, tag somebody in that needs to see it. And then if you want to get a hold of me, you can always do so on Instagram. It's Brandon Elliott Investments. Otherwise, facebook.com/Brandon Elliott Investor. And then you can always check out creditcounselelite.com. So www.creditcounselelite.com. Love you guys all so much. Till next time, God bless.